Hello, everybody. Very good evening. So we've got. I hope you all had a very good weekend, and today's is the last of the topic that is allotted for me, um, and it is a very interesting topic. Just as we saw equalization levy and transfer pricing, this is another very interesting topic. In fact, I would say this is a kind of a new evolution that we are seeing in international tax. So I would say we are in a new phase of international taxation. So we will be discussing about that part. I've tried to I've tried to cover it with few practical examples as well to make you appreciate it better. As always, I'll be happy to get any of the questions. So, but before I move ahead with today's session, which is actually on fundamentals of base erosion profit shifting. I'm sure many of you have already seen or we've discussed about what base erosion profit shifting. I just thought we will do a quick MCQ on equalization levy. So that way we will try to have a kind of a recap on equalization levy, the last session which we covered. So as always, as part of my recap as well, I would just quickly, help you, guide you through the answers. But then this will also act as a, for you guys to come out with your answers on equalization levy. So there, as if you recollect, there are two kinds of transactions. The first leg of transaction is for online advertisement. The second leg is for e-commerce supply or services. So I have accordingly split the MCQ. So now I would, as always, you guys have been very participative when it comes to the MCQ. So I will increase the size so that it's visible for you. And then I would really appreciate if you can keep providing your answers. And then we will, in any case, come back and discuss them. So as always, we start off with an easy one. Equalization levy was introduced under the so all these whiles, we're talking about paper 7, which is direct tax laws. So, one major legislation under direct tax laws have always been Income Tax Act. But if you recollect, I mentioned that, equalization levy was not introduced under the Income Tax Act, and you will not find the charging provision in section 1 to 298, even though there are references to equalization levy under the Income Tax Act, but it was not introduced under the Income Tax Act for a very simple fact that this is applicable only majorly for non-residents. So therefore, since this is the target is the non-resident digital companies who are actually trying to gone are those days where I need to set up an entity in India. So, everything happens online. So there's no need, I always say this, it's a very cliche dialogue, but it's very popular. Geography is history now. What I mean by geography is history is you can sit from anywhere and do business anywhere. So there is gone are those days where I go set up an office in US, yeah, UK, Estonia. Yeah, people do expand, go globally, but then it's quite easy to access to the global large market. So therefore, since businesses have evolved, the laws have somehow not been able to be updated. So permanent establishment is one thing which we have seen, which is a 100-year-old concept introduced in 1920. So unfortunately, it is not. So therefore, people have, especially the new age digital companies, have made use of this, and thereby they have tried to evade source taxation. So which is why the Indian government, in order to ensure people don't take the treaty benefit, remember the right florist case, introduce equalization levy in a different legislative mode. So I want you to tell me which one is that. So before I move to question number 2, for one particular aspect raised by Neil, to equalization 2.0 is a recent introduction. I believe you will have the updated version of the study module anytime soon. So therefore, so you will have equalization 2.0 in your study material. It will get reflected soon in the BOS website. So this is for Neil. Don't worry. It's almost everything is done. So it's just you will soon see the equalization 2.0 in the material. Now coming to second question, specified services mentioned under section 165. So this is the first of the transaction on which equalization levy is defined as online advertisement, any provision for digital advertising space or any other facility or service for the purpose of online advertisement, any other service notified by the central government, D, all of the above. So we need to find, I want you guys to tell me what the specified services meaning as per the first leg of transactions which we discussed. Is it online advertisement? Just think before you answer. Online advertisement, any provision for digital advertising space, any other services, all of the above. Now, question number 3, equalization levy is levied at dash percentage on the amount of consideration for online advertisement under section 165(1). So under section 165(1) of the Finance Act, equalization levy at what percentage? Is it at 4%? Is it at 5%? Is it at 6%? Is it 2%? Again, the transaction I'm looking at is the online advertisement service. So I want you to tell me which is the right percentage. Moving on, question number 4. Equalization levy is exempt up to rupees dash on consideration received by a non-resident from a person resident in India. Basically, threshold is given. So therefore, for a non-resident who receives equalization levy, so this is again on consideration from a person in India for providing online services. I want to know what is the threshold. So equalization levy is exempt. Oh, I'm seeing some very good answers. Good. 50,000, 1 lakh, 1 crore, 2 crores. Now, moving on to question number 5, I want you to validate the statement as true or false. Equalization levy is levied on a person resident in India for providing online advertisement services to a non-resident. Look at the aspect here. Equalization levy is levied on a person resident in India for providing online advertisement services to a non-resident. So consideration is received by a person resident in India. So I want you to let me know, is this statement true or false? Please understand whom are we targeting equalization levy? We are targeting the non-residents. So therefore, based on that, you answer question number 5. Let's move on to question number 6. Again, I want you to validate the statement. Hulk India Private Limited, which is an Indian company, made payments for online advertisement to Avengers LLC US. Avengers has a branch in Chennai, India. So equalization is not applicable since Avengers has a PE in India. So the consideration is received by Avengers for providing online advertisement services. The statement says equalization levy will not be applicable because Avengers has a permanent establishment in India. So for question number 6, you can give your answer. Is it true or false? This statement. Moving on, question number 7. For specified services, that is online advertisement provided by a person non-resident in India to a person resident in India, the onus is on whom to collect the equalization levy. The onus is on the service recipient, that is the person resident in India. The onus is on the service provider, that is the non-resident provider. On the intermediary bank of the Indian service recipient. D, none of the above. D, none of the above. So whose responsibility is to collect online advertisement related equalization levy? Discharge and collect the equalization levy. Detect, discharge. So this is 7. And question number 8. A non-resident received consideration from a resident in India for 10 lakhs on 24th November 2020. The person resident in India must discharge how much and remit. So in question number 8, I have given the answer directly for 7 as well. The person resident in India must discharge how much and he should remit the EL within. So I want you to tell me what is the amount and within which the equalization levy should be remitted. Basically, the due date for remitting the equalization levy. So the date of transaction receipt is 24th November 2020. So this is a key point. Now the amount is 10 lakhs. So whether the equalization levy is 50,000 and it has to be deposited within 30th November, or is it B 60,000 within 7th December 2020, C 50,000 within 31 December, 60,000 within 31st March 2021. Question number 9. I don't know whether I had an opportunity to discuss this, so I thought I will put this. I'm not sure whether I discussed. I remember I didn't discuss this, but anyways, I hope you guys had a chance to look at the material because we are talking about EL 1.0. Anyways, for failure to deduct and remit the equalization levy within the due date of filing return of income under section 139(1) will warrant disallowance under section 40A 1B for the resident service recipient. So failure to deduct and remit the equalization within due date will warrant disallowance under section 40AB. So a resident, when he makes a payment for online consideration, it acts as an expenditure for him. So the statement is failure to deduct and remit the EL will warrant disallowance under section 40A(IB) for the resident service recipient. I want you to answer whether it is true or false with regards to question number 9. Now, before I go to the next part of it, that is EL 2.0. So let's quickly discuss the answers. Now, equalization levy was introduced under the Finance Act. The reason for introducing under the Finance Act is they don't want the non-resident to take the treaty benefits because the treaty have not been updated. You can always amend your domestic law, but then section 90 clause 2 or section 90 subsection 2 rather, section 90 subsection 2 of the Income Tax Act says act or treaty whichever is beneficial to the assessee. So therefore, if under the treaty, if there is no PE for me, nothing is taxable, then I will go towards treaty. So therefore, no point amending your domestic alone. Treaty also has to be amended. So since there is no consensus, countries were not. So when it always treaty, unlike your domestic where I can always go and keep passing ordinance, every year I can keep amending it. It's not possible to amend treaty because we have bilateral treaties. So the other party should also come to the negotiating table. And amendment and all those things is a very long drawn process. Negotiation has to happen and all those things. So therefore, India smartly introduced it as part of Finance Act, and they want to tell you that you cannot avail treaty benefit because it is not an Income Tax Act levy. It is a levy under the Finance Act. Now, second, specified services, all of the above. Online advertisement, any provision for digital advertising space. So they're basically covering anything relating to online advertisement. Even if I give a provision for digital advertising space or facility or service for purpose of online advertisement, that will also come. Any other service notified by central government, this is the definition of specified services. So that is what I am trying to test here. Any other service notified, till date, no service has been notified under 1.0. Of course, they have extended the scope for different e-commerce operators, supply services. But however, under EL 1.0, they have not notified anything. So therefore, all of the above. This is a definition under section 164. Third, equalization levy is levied at 6%. So for online advertisement, it is 6%. EL is exempt up to a very small amount of 1 lakh. Good. Validate the statement as EL is levied on person resident in India for providing online advertisement to a non-resident. So here the consideration is received by a person resident in India. So therefore the statement is false. They are not targeting Indian residents because Indian residents anyways he will show the income in India. So very easy to collect taxes. So therefore this is false. I see anyway, I see one answer as true. It's not true, Preeti. It's false because we talk the consideration should be received by a non-resident. We are targeting non-residents here. Sixth, validate the statement as true or false. So since Avengers has a P in India, equalization levy is not applicable. So because again P is there, so it's easy for me to collect the taxes. So hence a person resident in India not there, and similarly for non-resident, if he has a P in India, then equalization levy will not be applicable. With regards to 7, the onus is on the service recipient. That is the person resident in India, he has to deduct and discharge. With regards to 8, it is 10 lakhs into 6%, so it's 60,000, and the EL has to be remitted within 7th December, that is within 7th of the next month. So 7th December 2020. Now 9th, failure to deduct remit, yes, it will warrant disallowance. So the answer to it is true. It will warrant disallowance. This is something we didn't discuss. And disallowance will be 100%. So basically, it is to ensure that the Indian resident recipient ensures he deducts equalization levy. Otherwise, it will be disallowed at 100%. Unlike your 30%, here it is equalization levy, entire 100% of the expenditure will be disallowed. So this is something which I wanted to share. Now moving on to question number 10. So this is the next segment of the next set. The one is online advertisement. The second leg of transaction for which equalization levy is applicable is for e-commerce supplier services by a non-resident e-commerce operator. So question number 10. On and from the first day of April 2020, this is a new introduction applicable from assessment year 21-22, and that is why this is not mentioned currently in your study material, but this has been updated and you will soon receive EL 2.0. It is colloquially called EL 2.0. So you'll get EL 2.0 related contents, whatever we discussed, soon in the study material. On and from the first day of April 2020, equalization levy at the rate of dash percentage of the consideration received or receivable by an e-commerce operator from e-commerce supplier services. So this is levied on an e-commerce operator for providing e-commerce supplier services to a person resident in India. Then what is the rate? 4%, 5%, 6%, or is it 2%? You can give your answer for question 10. Neil, yes, you will get the study. You can see it is very nicely captured, so it will be easy for you to refresh. Just wait for the study material, Neil. It has come out very well. The team behind it has drafted it very nicely. So I think I've seen it. I've used it as well. So it's very good. So you will get a fair idea. So don't worry about it. Whatever we discussed has been nicely encapsulated and captured in the study material. On question number 11, moving on. E-commerce operator means a dash who owns, operates, or manages digital or electronic facility or platform for online sale of goods or online provision of services. So basically, e-commerce operator is a person who owns, operates any digital or electronic facility or platform for online sale of goods or even for online provision of services, or for both. So whether should he be a resident, should he be a non-resident, Indian citizen, foreign citizen. So we all know whom are we targeting here. So very straightforward answer. Moving on to question number 12. Equalization levy on e-commerce supplier services shall not be charged if the gross is. This is basically threshold. So what is the threshold? If the sales or gross receipts of the non-resident e-commerce operator is less than dash rupees during the previous year. 1 crore, 2 crore, 3 crore, 4 crores. So non-resident e-commerce operator up to certain amount of transaction that he receives from e-commerce supplier services provided to a person resident in India, then what is the threshold? 1 crore, 2 crore, 3 crore, and 4 crore. Question number 13. E-commerce supplier services for the purpose of the equalization levy 2.0 means online sale of goods owned by e-commerce operator. So now we are talking about what is an e-commerce supply or services. Online sale of goods owned by e-commerce operator, online provision of services provided by e-commerce operator, online sale of goods or provision of services both facilitated by the e-commerce operator, or all of the above. So this is, now we are targeting.
Get that. Could you try again?
Who is a e-commerce supply or services? So you have to tell A or B, C or D. Now question number 14, validate the statement as true or false. The collection and recovery of equalization levy on e-commerce supply or services shall be paid by the non-resident e-commerce operator. So I want you to know whether, I want you to disclose whether it is true or false for question number 14. The collection and recovery mechanism for e-commerce supply or services, the onus is on the non-resident e-commerce operator, that is the service provider. Is it true or false? Question number 15. Validate the statement as true or false again. Equalization levy on e-commerce supply or services shall be attracted for the non-resident e-commerce operator who sells data of persons resident in India to a non-resident. So the question all I'm trying to check here is, we all know it is applicable for non-resident e-commerce operator, but the services should be provided to a person resident in India. In this case, he sells data of person resident in India, but it is sold to a non-resident. So this is a NR to NR transaction. We've always seen it is NR to R. So here it is NR to NR. So I want you to know, in that case, equalization levy, whether it will be attracted or not. Here it says equalization levy is attracted. I want you to let me know whether it is true or false. Question number 16. Again, validation. XYZ, a non-resident entity based in Singapore. This is very similar to what the problem we did in the last, the last problem which we did in the last class. A non-resident entity based in Singapore owns and operates. So he is a non-resident e-commerce operator. He sells its goods to persons in Nepal. So sale is happening to a non-resident. However, the persons in Nepal use an IP address located in India. Therefore, equalization levy is applicable to XYZ and Co. Whether it is true or false. Question number 16. Question number 17, the last one. Superman GmbH, a German company, made payments for online advertisement to Batman LLC. Okay. So Batman LLC is a US company. As per the contract, advertisement of Superman products must target customers residing in India. So therefore, the contract says the customers must be residing in, that is the ad which will be provided by Batman LLC, which is a US company. It should target the customers residing in India. Batman LLC is of the view that equalization levy is not applicable since the services are provided to Superman GmbH, a person who is not a resident in India. So the Batman says, I am a non-resident e-commerce operator, agreed, but equalization levy will not be applicable because I am providing services to another non-resident. So now we will quickly go through the answers. So all I've tried to done through this is just to give a recap on whatever we discussed, so that to establish the concepts pretty strong and hard into your mind. Now question number 10, yes, straightforward. This is 2%. So please remember 6% for online advertisement, 2% for e-commerce operator. Question number 11. Question number 11, e-commerce operator means a non-resident. So we are targeting only non-resident e-commerce operators like Amazon, US or eBay. So we are targeting non-resident. Resident e-commerce operators, not a problem. Like Flipkart, ShopClose, Snapdeal, pretty easy as well. Because they're all, in any case they're in India, it's easy to recover taxes from them. Question number 12, equalization levy threshold. So you saw 1 lakh was the threshold for online advertisement. Here the threshold is 2 crores. So up to 2 crores, a non-resident, they're basically small non-resident e-commerce operators need not worry. So up to 2 crores, they make through e-commerce supplier services to a person resident in India. They need not worry about equalization levy. What is a e-commerce supplier services? All of the above. Sale of goods owned by e-commerce operator, provision of services provided by e-commerce operator, both facilitated. So he need not even own, even he facilitates. So all of the above. So very wide definition of e-commerce supply or services. Now question number 14. Question number 14. Validate the statements as true or false. The collection and recovery is with the non-resident e-commerce operator. Yes, it is true. It is true because I mean, the point here is, if you remember in EL 1.0, it is on the service recipient, which is the Indian. But here, they have decided that let us not bother the Indian persons. Let the e-commerce operator itself come and do all the procedural aspects in India. So it is NR e-commerce operator who will be responsible. So this is true. 15th. EL on e-commerce supply shall be attracted for the non-resident e-commerce who sells data of persons resident in India to a non-resident. So this is also true. So what they have done is, if data of Indians are sold, sells data of persons resident in India. So therefore, they are saying there is a nexus connection in India. So hence, even though it is NR to NR, but merely because data of persons resident in India sold, equalization levy will be attracted. Number 16th, XYZ, a non-resident. Again, sale is happening to a person in Nepal, but however, the Nepal person uses an IP address located in India. So therefore, India says you are using India's IP address. So there is a nexus again, and hence taxable. NR to NR. So this is also true. This is also true. Now last, Superman German company made payments for Batman, and one of the conditions is, or rather the contract says, the advertisement should be targeting persons resident in India, must target customers residing in India. So this is again NR to NR and targeting Indian residents. Therefore, EL applicable. So hence answer will be false, because Batman LLC says equalization levy is not applicable. This is false. This is not a right statement. It is applicable. So equalization levy is applicable. They are targeting Indian residents. Very good. Okay, perfect. So this is with equalization levy. As I mentioned, today all you just have to just revisit the concepts again before the exam. 6 marks, easy, minimum 6 marks. You can, low hanging fruit. All you have to do is just grab them. So with this, we will move on to today's session. I spent more time on equalization levy because EL 2.0 is very relevant, and it has created a lot of controversy. So therefore, there's a very high possibility that the examiner will try to test on equalization levy 2.0. One, again, I reiterate, one very important point is this is very, very important. So especially for those of you writing in assessment year 21-22, section 10 clause 50 exemption is not available for EL 2.0. So therefore, there is a possibility that this is very important. Is not available for EL 2.0 for assessment year 21-22. From 22-23 onwards, it is available. So both EL and IT, both will apply in this scenario. So a question will be there that for equalization levy 2.0, maybe I should have put that in the multiple choice. So equalization levy 2.0 is attracted. Assessing officer also goes and invokes Income Tax Act. The assessee claims that he is exempted. The non-resident e-commerce operator claims that it is exempted under 1050 because it has already suffered equalization levy. Unfortunately, for assessment year 21-22, the 1050 exemption is not available. It is available only from assessment year 22-23. You may ask why. It is a political statement. The government want to, make life difficult for non-resident e-commerce operators because EL 2%, then maybe say let's say 10%, so heavy 12% additional tax deduction. So these non-resident e-commerce operators will go and tell their country, please quickly let's try to get a solution for taxing digital. Let's get on to amend that treaty, do something. We are suffering unilateral because these are unilateral measures, no treaty benefit. So this is a way of a strategy for India to push the other country to come to the negotiating table. So that is the only possible reason that you may see why this is not applicable for assessment year 21-22. So with this, we'll move on to today's session. So this is again a very, very new concept, which is fundamentals of base erosion. What I mean new concept is, if you remember the last 4 sessions we did on transfer pricing and equalization levy. So one common factor in all these 4 sessions which we did is very simple: base erosion, profit. They're all anti-avoidance. And what we are going to discuss today is also the same anti-avoidance. I'm only trying to go a little further. I'm going to talk something about a very new concept in international taxation, but the underlying essence remains the same, which is base erosion, profit shifting, that is tax avoidances. Now, before I go into the tax avoidance part, I just want to get into the fundamentals. Fundamentals not of base erosion, fundamentals of international taxation at the first instance. Now, what is the fundamental of international taxation? I'm sure you all would be familiar with it, but I want to revisit it so that it will be easy to get into the newer concepts. Let's assume there are 2 countries and there is a seller so there is a seller A and there is a buyer B. So now, when will international tax come in? So when the seller sells a goods or services to the buyer in country B. Now the issue is, when he sells, country A, whatever profit he makes, would want to tax it. Country B says buyer is in India or the buyer is in country B. So therefore, the source for you to make money is from this country. So I am going to tax the profit. I am also going to tax you. Now, what happens for the, he's going to tax the, he's going to tax the seller here. So country B wants also to tax the seller, Mr. A or A Inc., whatever it is. Country A says, look, you are my resident, so you are selling it. So you have to, whatever profit you make, pay tax in your resident country. So when I sell to a buyer in country B. Country B says, you have a buyer in my country, so therefore my country also deserves to tax you, because your source, where is your origin? You are earning money only from my country. So country B also wants to tax A. Now let's so what will happen? So eventually what you're going to see is double taxation, because country A wants to tax on the profits, country B also wants to tax A, because they believe he has made money from my country, so I am responsible for him, so I should also get the taxation here. This is called, country B wanting to tax is called economic allegiance. This is what I would have mentioned it as nexus. Economic allegiance. Look, there is an economic allegiance for A in country B. So therefore, country B says, you have a buyer here, so therefore you should pay tax in my country. So this is what in taxation it is called economic allegiance. So this economic allegiance concept paved way for source taxation. Where there is source, the source country will have the right to tax. Resident country will always get to tax the residents. This is called personal allegiance. Because as I mentioned to you, India can always come and tax me, you, because we are all citizens of India. There's a personal allegiance. They will say, you are my citizen, I will use my sovereign power, you will come and tax. But when I provide, say, legal services in Austria will come and say, look, you provided services to an Austrian service recipient. So there is an economic allegiance. So pay tax in Austria also. That is what is called source concept. Now, what this happens now, there is a double taxation, because my home country also wants to tax, and where I sell, they also want to tax. This is very basic, fundamental aspect. Now, because of double taxation, what will happen? Mr. A has to suffer heavily, because he has to pay taxes in both the countries. So therefore, he is very upset, because he has to pay tax in his home country, and country B also says, you should also pay tax here in my country, because you are paid. So now what will this happen? Now, what are the consequences of double taxation? The consequences is pretty straightforward. So what will happen? Tomorrow, the seller in country A will not be very keen to go to country B at all, because he says, look, I'm unnecessarily taxed by country B. So why should I? So they will all try to do it within their own country. So therefore, what happens? The consequences of double taxation is it hampers free flow of capital, restricted trade, because everything happens within the country, it is not going about. And then there is no foreign investment happening, protectionist. Now, more importantly, international relations. Now, one of the reasons for cross-border trade itself was, it emerged after the First World War. That's how the League of Nations was created, which is now your United Nations. The idea was, if countries start doing trade with each other, country A with country B. So once you start doing trade, steel manufacturing, coal, these were the initial stuff, steel and coal. Once you start depending on trade, once you start monetary movement happening, commercial movement happening, war will come down. Because you don't want to go fight with the person who's giving you money, right? So wars will come down. So one of the main reasons for cross-border trade itself is war. After First World War, they decided that countries should start doing trade with each other. So more dependence on trade, more foreign investment, open up the market, depending on each other, will stop wars coming in. Wars, we can avoid war. So, and thereby this thing. But then after they realized that, once they opened it up, there was this double taxation. So that's how your double tax avoidance agreement started to emerge. Okay, let's get on to an agreement. So that way, let's try to come with some solution to ensure that there is no double taxation happening, because my home country also wants to tax, and where I do business, they also wants to tax as a source, economic allegiance. So I'm unnecessarily getting tax in two places. So therefore, oh no. So therefore, we need to ensure that there is no double taxation. So to avoid double taxation, double tax avoidance agreements was entered, which are called tax treaties. Your bilateral, and this was entered bilaterally between countries with each other. They entered bilaterally, so that way they can avoid double taxation of the same income. So coming back to our first example, the seller in country A can avoid double taxation if there is a treaty between country A and country B. Now, how normally they will give avoid double taxation is whatever taxes you suffer in country B. So coming back to this example, I'm only talking basics of international taxation. So whatever taxes suffered in country B, in country A, country A will either exempt it or will give credit. Basic. So that is, this income will be exempted in country A, the sale transaction. So that way there is no double taxation. You only tax in one country, which is B. Or whatever tax is suffered, say 100 is tax suffered in country B, then country A will say, include the income, whatever is income, I will give you credit for it. So in my tag, like just like your TDS, I can take credit of whatever taxes suffered. So this way we can avoid double taxation. So this will give relief for seller in country A to go do transaction in country B, to do transaction in country C, country D, and similarly vice versa. They'll also come. So investment will happen, trade will happen, and everybody will be happy. So this was the objective for entering into tax treaties, to avoid double taxation. Now, let's see what has happened. So this I'm talking about, this was the situation. So all these things emerged in 1919 or 1920 early. Today we are in 2020, exactly 100 years. So these tax treaty principles are a more than a century-year-old concept. They're not, something new. So purpose of the tax treaty: eliminating your double taxation, clarifying your fiscal, basically, there is certainty, tax certainty is there, sharing of tax revenues between countries, promotion of cross-border trade was happening. So this was the reason for entering into, that's why it's called double tax avoidance agreements. The tax treaties are called double tax avoidance agreements. So idea is to avoid double tax, so therefore you promote cross-border trade and investment. Now what has happened? What has happened, unfortunately, is these 100-year-old concept, you would have heard this, tax evasion, tax planning, and tax avoidance. So over a period of time, it has paved way for all these three: multinational enterprises, globalization, countries opening. Now, what is tax evasion? Or I would ask you, what is the difference between tax evasion and tax avoidance? Are they one and the same? I would be happy if you can give your views as well. Is there any difference between tax evasion and tax avoidance? If you recollect, I keep saying it's a tax avoidance, anti-tax avoidance mechanism. So are we talking about, then what we have seen tax evasions. So does that mean tax evasion and tax avoidance are synonymously used? And we've always known tax planning, Supreme Court, be it India or rest, but various courts have said you can always legitimately plan your taxes. The word used is within the four corners, legitimately. So if there is a law which provides me to legitimately plan my taxes, then why not? So this is a very dicey situation, especially how if the relationship between tax evasion, tax planning, and tax avoidance. So I've tried to give it a relationship. So I've used a Venn diagram to see if I can give a relationship structure to it. Now, if you see tax evasion, tax avoidance, it's again a very common cliche. They say there's a thin line of difference between tax evasion, tax avoidance, and I would also say there is a very little difference between tax planning and tax avoidance. So, tax evasion, if I may have to define it, is this which is illegitimate. For example, in GST, we have seen fake invoices. So, where it is blatantly illegal, when even in income tax, we have seen people using false deductions to claim ATC deductions, bogus bills. They are all tax evasion. So, very straightforward if I can define it. Now, tax avoidance and tax planning becomes very tricky, and that is where we have a lot of issues. And that is where we chartered accountants, lawyers, try to always, there's a tug and war. Taxpayer says it is planning, tax administration says it is tax avoidance. So, if I may try to define what a tax avoidance is, which is actually illegal tax planning or unreasonable tax planning, aggressive tax planning, whatever you want to call it. So this is always a tug and war. So that's why there is a gap here. So between tax planning and tax avoidance, there is always an issue. Taxpayer says, I have followed the rule of law, or I have gone within the four framework of law. Tax administrator says, very good, Neha. Good attempt. So tax avoidance is where, even though it is within the framework of law, but still you have gone extra. So therefore, we are talking about subjective concepts. So that is why it becomes very interesting. We are seeing a lot of litigations happening as to whether it is tax planning or tax avoidance. So that's why government is saying, if it is very slightly okay, tax planning stretching into these areas, I'm okay. But when you go aggressively, when you go beyond certain limits, then it becomes tax avoidance. And for example, transfer pricing. So they are saying, okay, I'll give you arm's length range. You go beyond and you try to shift profits. These are tax avoidance. Debt equity. So we will see some examples. Now, the reason for me giving this background is these are all global phenomena. It is not restricted to India. Everywhere we are having this issue. Tax evasion to a larger extent is pretty, at least that way, clear, because it talks about straight illegitimate stuff. But then tax planning, tax avoidance is little subjective. Now let's try to see what are all the now what are the reasons for tax avoidance happening? Now, for example, we have, thankfully, the last 4 sessions, we have seen some of the reasons for tax avoidance. Arm's length principle, transfer pricing is one reason. And there's something called separate entity. In taxation, if you see, it is always a concept of separate entity. Even though it is multinational enterprise, there is no concept of consolidation. You can always say, let's bring a, just like our accounting consolidation, we can always have a tax consolidation. Bring all, because the group, somewhere down the line, they will try to, reduce taxes in countries, but eventually it will all be under one single basket. So it's very easy. And then, why don't we do a group taxation? But the problem with group taxation is we are talking international taxation. If it is in one country, not a problem. We can between, especially in India, we can always say it's easy. I have different companies set up in Tamil Nadu, Maharashtra, Bombay, no problem. It's easy to do a group tax. But imagine we're talking about India, Belgium, UAE, Singapore, Hong Kong, US, Ireland. So they are present all over the world, and every country will fight. No, I deserve it. So that's why we went into a separate entity in income tax, in international tax. But these separate entity actually have paved way for more tax avoidance strategy. Setting up companies in low tax jurisdictions and do this base erosion profit shifting. And then the PE concept we have discussed already. I need to have a setup in another country, the economic allegiance we discussed in the example also. So how countries have been abusing the permanent establishment. Now, so eventually the bottom line, what I'm trying to drive is the reason for entering tax treaty was to avoid double taxation. But after 100 years, or maybe after 90 odd years, you look back and you see it has actually facilitated double non-taxation. In many cases, it has only helped in facilitating double non-taxation or facilitating avoidance of taxes in one country or the other. So what actually started as a very novel concept to encourage foreign trade, to avoid double taxation, today we have come to a stage where countries have started to lose revenues on taxation because multinational enterprises have entered into something called double non-taxation. Now, how is this possible? It's possible through treaty shopping is one concept. Find out which treaties are beneficial. Set up. I'm sure many of you will know this. Head office, branch office are considered separate entity. Exactly, Deepa, you're right. So you can see, so all the separate entity helps to plan my taxes in each of the country accordingly. So it has gone to a stage where I can always plan my taxes and avoid taxes, and countries are losing large amount of taxes. So now, what is treaty shopping? Many of you know. I'm sure will be knowing about treaty shopping, but I'll give you an example. What happened was in India-Mauritius treaty, tax treaty, when it was entered, capital gains for Mauritian resident will be taxable only in Mauritius. So what is tax treaties? Tax treaties will tell you allocation of taxing rights. It is not a separate, it only tell who will have the taxing rights, whether you or me, or if both of us are going to have, then we will give credit. So basically tax treaties is for allocation of taxing rights. So under the India-Mauritius treaty, a Mauritian resident selling shares, then capital gains will be taxed in Mauritius. Similarly, Indian resident selling shares, then taxability will be in India. So this was the treaty arrangement. Now what happened? Lot of US companies, I am unable to remove it. So a lot of US companies, instead of coming directly to India, set up a intermediary holding company in Mauritius and then came to India. The reason for this is when they sell India shares, so they will tomorrow sell these India shares to some other US company during the merger or acquisition. At that point in time, they will not sell India shares, they will sell the Mauritius company shares to US. So that way, they will, because US Mauritius had some benefits, so they will try to avoid unnecessary capital gains tax in India. Because in the India-US treaty, this kind of benefit was not available. That is, under the India-US treaty, capital gains will be taxed in both the states. And US had some domestic law issues as well. So to avoid unnecessary tax in US, all these US companies which came to India, when India opened up liberalization, they came through Mauritius. Mauritius was just a normal island country which was dependent on, not even on tourists at that point in time. Their only this thing was coconut and other things. Now, of course, the good tourist spot. That part today, it's one of the most top financial hubs. So what happened was, this is called treaty shopping. So you will go and find which treaties are beneficial, set up a shop there, and then use that country for evading or planning they call the multinationals call it planning, but the tax administrators call it tax evasion, tax avoidance. So bottom line I'm trying to tell is, these tax treaties are over a period of time facilitated for double non-taxation. If you're more interested about how this India Mauritius work, I'm not spending my time, but if you're interested, you can. There's a lot of papers available on the web. You can always look at it. I will also share some other tax avoidance strategies. So all these are prelude for the base erosion that we are going to discuss. I'm going to discuss a concept called multilateral instrument. So I'm only trying to build you towards multilateral instrument. Why do we need a multilateral instrument? What is a multilateral instrument? All right. So now let's look at this tax avoidance strategy. There is a company in country A, and there is a B company in country B. Now, A company's subsidiary is the B company. So, A company is parent entity, B company is the subsidiary. Now, what happens? A company gives loan to B company, to its subsidiary. Now, the loan, let's take, is a financial instrument. So, what they're doing is they're smartly giving a hybrid financial instrument. Now, what is a hybrid? Let's say they're giving the loan as a compulsorily convertible debentures. CCD is treated as debt in India. So what they do is, the CCD is given as a loan. Compulsorily convertible debentures arrangements can, because it's all group companies, so arrangement can, so loan agreement, debenture agreement, all those things are done, and they give it as a loan to CCD. So now let's take this country B for a moment. Let's assume it is India. In India, CCDs are treated as debt. And the country A, where the parent company is, you can take it as US or America, US. So there, these CCDs are treated as equity. So this is a problem you will have in financial instruments. This is an accounting methodology. So again, there are aspects beyond taxation also. So these accounting, the hybrid financial instruments, these modern day financial concepts also, and each country have their own way of treating these instruments. So, and new financial products, innovative financial products are introduced to all, to facilitate these kind of things. Now, what happens is, so this CCD is treated as debt in country B, and it is treated as equity in country A. Now, we found out that in country A, dividends are exempt from tax. They don't want to. So, normally many countries, you have something called participation exemption. That is, they will not tax dividends from foreign subsidiaries, because they take some countries, especially developed countries, give a participation exemption. They will not tax the dividend. Instead, they will try to recover it through capital gains or some other mechanism. So dividends from foreign subsidiary is exempt under the laws of country. Even in India, if you see, dividends from foreign subsidiaries is taxable at a beneficial rate of 15%, 115 BBDA. So therefore, you have even in India, in order to encourage people to bring back dividends from foreign subsidiaries, India taxes only at 15%. Some countries don't even tax it. Why they don't tax it? As I mentioned to you, they will say you bring back the money into the home country. So at least the money will be there and it will again be redeployed or utilized for domestic investment, foreign exchange fluctuation. So they say to encourage the parent to bring back the cash as a cash repatriation strategy, bring back these dividends. Many countries exempt dividend from foreign subsidiaries under country A. Now, what are the tax consequences? Now, let's see first tax consequences in country B. So, country B, when it will pay interest. Now, when it pays interest, what happens? Deduction. So, there is a base erosion happening. Country B will pay what? So, this what the interest payment, because under country B, that is India, CCDs are treated as debt. So, interest paid. So, you get a tax deduction. So, there is a tax deduction and country B will pay less tax. Now, let's look at country A. Country A will treat this interest as dividends because under their domestic law, the loan is treated as an equity and dividends is exempt. So, no tax. So, eventually, if you see, there is a deduction that is claimed in country B and no income. So, this income, if you see, is not taxed anywhere. In fact, it has helped in facilitating reduction in country B. So, these are all very much possible in a group transaction. I hope this structure is clear. So, I want to tell you, these are some of the commonly used tax planning strategies. Again, depends upon which side you are. If you are a taxpayer, you will call it as planning. But if you are a government, the administrator will say this is a tax avoidance. So they use, these are all called hybrid financial instruments. Why hybrid? They have both the status, hybrid. Hybrid financial instruments. So country B treats it as a debt, country A treats it as equity, CCD. So therefore, country B you will get deduction. This will be a high tax country normally. So you pay less tax here because you take a deduction and you take the money out of country B, go to country A. In country A, this is treated as an equity and therefore equities, when it is an equity, it is treated as a dividends and dividends are exempt. Dividends are exempt. Dividends are exempt in this part. So therefore, consequences, no taxation anywhere. In fact, you reduce the taxation. So this is one strategy that is deployed by multinational enterprise. Let's move to, I'm just going to give 2 or 3. I'm going to show you 2 commonly used tax planning strategies. Then we'll get going. So hybrid instrument leading to mismatch arrangements. This is called tax mismatches. We saw, debt, equity. So this leads to hybrid. These are called as hybrid mismatch arrangements. Just jargons. So don't get, we're all very fond of jargons, right? Business jargons, professional jargon. So they call it hybrid mismatch arrangements, a jargon, because there's a mismatch. So leads to a deduction, that is deduction in the source country and income not included. So therefore, this income is not included because it is treated as a dividends and dividends are exempted. So multinational enterprise enjoys this transaction. So this is one. Now let's look a similar kind of a tax avoidance, another kind of a tax avoidance strategy. These are again because of different ways in which countries operate. Now, XYZ LLP, a UK partnership firm, a UK limited liability partnership firm, is a firm of chartered accountants. An Indian company engages the services of the UK chartered accountant firm for a forensic audit engagement in India and paid fees of INR 10 lakhs. Now, ideally speaking, when you make a, so this is clearly an India sourced income because they're engaging them for forensic audit. Let's assume they have come to come to come to India and done this work. So technically speaking, this 10 lakhs should be taxable in India. Now, if you look at the India, okay, so Deepa wants me to explain the consequences on the previous situation. So I'll, for her benefit, I will do it again. See, Deepa, I'll repeat. Now, I'm trying to explain here how multinational enterprises make advantage of different country laws and situations. So here what happens is a company gives a loan to its subsidiary country B. Now, how they are giving this loan? They're giving it in the form of some fancy hybrid financial instrument. So let's take for you all to relate compulsory convertible debentures. CCD in India is treated as a debt. So therefore, what they do is, okay, for a moment, let's take country B is India. So the parent company will give the loan in the form of convertible CCDs, compulsorily convertible debentures. So in B company's book, this will appear as a loan. And then what will B company do? They will make interest payment. They will make interest payment. All right. Now, so once B company makes this interest payment, B company makes this interest payment, this will be an expenditure for B company because interest is tax deductible. So profit will be lesser, tax will also be lesser. This is from a country B perspective. Let's go to country A. In country A, the CCDs are treated as equity. So since these are treated as equity, these are treated as capital, this interest payment is characterized as dividends. Under the A country's laws, dividends from foreign subsidiary is exempt. In many countries, you have this something called participation exemption, especially in Europe, they give you this. So you get dividend from your foreign subsidiaries. The parent country will not tax you. So it is exempt. Like how you have exemption under 10 clause 34, you have exemptions available. So therefore, these dividends are exempt in country A. The bottom line, if you see, this payment is not taxed anywhere. Not taxed. Sorry, it is not taxed. Because country A exempts. And what has happened? In country B, you're also claiming it as an expenditure. So this is a very good tax planning strategy. So this is with regards to, this is what I was trying to explain in this situation. So these kind of hybrid instruments, different countries, different tax policies and treaties are also, they take advantage. So therefore, by using this, there is a tax avoidance or a tax planning that emerges. So this is one situation. Now let's look at another situation. I'm just sharing some commonly used tax planning, tax avoidance strategies. I hope the previous thing was clear, Deepa. Now let's look here. Here what happens? XYZ is a UK partnership firm and it was engaged by an Indian company to provide forensic audit engagement for 10 lakhs. So, ideally speaking, this 10 lakhs is taxable in India. Now, what happens is under the India UK tax treaty, the said payment is not taxable. So, what I mean by not taxable is under the India UK tax treaty, the taxing right maybe would have gone to UK. So, these are bilateral negotiated agreements. Don't ask me why India is not taxing it. So, this is an agreement. UK would have said, look, if you want a tax treaty with me, you should not tax professional services fee. You should not tax fees for technical professional service or technical services. I'm not going very deep into the treaty because that is not the subject matter for discussion. But then the treaties also give some benefit. So under the India UK treaty, they have mentioned that any UK these kind of services is not taxable in India. So which means the source country will not get the taxing right. So the said payment is not taxable, and therefore using section 92, that is treaty or act whichever is beneficial, the Indian company did not withhold any tax. Why it did not withhold any tax? Under the India UK tax treaty, this income is taxable only in UK. UK has the taxing right. Since UK has the taxing right, in India it does not have any taxing right. So treaty or act, whichever is beneficial. What is beneficial here? Treaty is beneficial because treaty says not taxable in India, taxable only in UK. So therefore, the Indian company which has engaged this UK partnership firm for forensic audits, when they make the fees, they will not withhold any tax. Why they will not withhold any tax? Because the income is taxable only in UK. Why it is taxable only in UK? That is what the India UK tax treaty mentions. India UK tax treaty mentions these kind of income by a UK partnership firm should only be taxed in UK. This is the agreement finalized, negotiated, entered between India and UK. So therefore, this income is taxable only in UK. Now let's look where the tax avoidance or planning comes. Other information we found out that this XYZ LLP, the UK firm, is a tax pass-through entity. In many countries, in India, partnership firm is taxable, firm taxable, partners exempt under your 10(2)(a). Partners are exempt. So it's a opaque or a non-pass-through. But in many countries, in UK, for example, firm is exempt, partners are taxable. So this is called pass-through. This is called transparent entities or pass-through entities. In India, I repeat, firm is taxable, partners are exempt under 10(2)(a), 10 clause 2(a). But in UK, what happens? The firm is not taxable, instead the partners is taxable. Why I'm telling you this? These are all strategies multinationals adopt. These are called the hybrid entities. Hybrid entities. Because in India, if you see, when making this payment, we will treat this as a separate entity. We will treat this as a taxable person. Because under the Indian domestic law, we always know that a partnership firm is a taxable person. So therefore, when India makes this payment, okay, it's a partnership firm. So therefore, India UK also says not taxable. So India will just like that make that payment without deducting any tax. You go further, you find out that in UK, it is a pass-through entity, which means the firm is not paying any tax. Only the partners will pay the tax. Now, incidentally, if you go further and see, the partners are actually tax residents of UAE. In UAE, there is no personal taxation. So therefore, from India, the money goes to UK, not taxable here because India-UK treaty. In UK, again not taxable because UK firm is not taxable. Only the partners are taxable. Partners are UAE tax residents. In UAE, there is no personal taxation. So this is a classic case of double non-taxation. So in the entire transaction, there is no tax suffered at all. So these are the kind of planning strategies. I gave a very easy example. So this is how normally countries will, multinationals will try to plan. Okay, let's, go to this country, set up, and according. I hope this example is clear. And make use of the treaties also, because many of these treaties would have been entered in, especially India's treaties with these developed countries are entered in 1970, 1980s. And normally developing country, in order for wanting investments, they'll give a lot of tax benefits also. So this is the classic case of, politics, countries taking advantage of another country. But anyway, this is what international tax beauty is. So therefore, double non-taxation. XYZ, India, UK says this income is taxable only in UK. And when you go to UK, in UK, this partnership firm is not taxable. Only the partners are taxable. And when they found out that the partners are actually tax residents of UAE, and in UAE, there is no personal taxation. So these are called, just like how you saw hybrid financial institutions, these are called using hybrid entities. So they will use these kind of hybrid entities where it is passed through, opaque, all those things, and then they will try to plan. All right. So one last strategy. This is something which we have already discussed when we discussed transfer pricing. I hope you were able to understand the tax consequences, how tax was planned smartly and tax was avoided in 2 and 3. If you have any doubts, please let me know. Now let's take one more example. Parent company has to give a loan to subsidiary. Now what they will do, parent company has to give a loan or to give equity. So instead of giving equity, we've already discussed it in thin capitalization. If you remember thin capitalization concept. So what they will do is, instead of pumping in equity, this parent company will set up another company in a low tax jurisdiction. Let's take country C as Cyprus. So what they will do is, this parent will infuse capital to the Cyprus entity. In Cyprus, tax rate is say 1%. Corporate tax rate 1%. Or many times it will be actually 0. So let's take 0 itself. So let's take 0. Let's take 0. So Cyprus, corporate tax rate, nothing is taxable, 0. See, now all these low tax jurisdictions, Cyprus, Bahama, British, see, they're all very small countries. They have tourists, or they will, how they will make revenue is, they will not collect taxes, they will collect in the form of registration fees. You set up a company like what you pay to MCA, they will collect, they will incorporate a company. You should watch this. I don't know where I put this. There's this movie called Laundromat in Netflix. It's about the Panama paper leak. Mossack Fonseca. You have heard about this Panama Papers leak. So go to Netflix. You can see, I'm sure as tax students or tax practitioners, you will enjoy it. The Laundromat is how the Panama firm setting up in Barbados. So you will enjoy it. You should watch this. It's a docu movie. So now coming back. So in this situation, the parent will, instead of giving equity to a subsidiary, which is a high tax jurisdiction, what they will do is they will put this equity in a Cyprus company, low tax, zero tax. Now, this Cyprus company, which is called as the financing company, now they will give loan. So instead of putting equity directly, the parent will set up a Cypriot company. The Cypriot company will give it as a loan. Now, this loan will be given to the country B subsidiary. Instead of lending directly to subsidiary, parent capitalizes a special purpose low tax company called the finance company. The finance company then lends it to subsidiary in country B. So from country A goes as equity to country C. From country C goes as loan to country B. Now this country B, please understand, is a high tax jurisdiction. Now why are they using this structure? Why are they using this tax planning structure? Let's find out. Now let's find out why did they use this structure. In country B, you remember country A, country B, and country C. So in country B, which has received a loan from the Cypriot company, let's look at first country B, the high tax subsidiary. There is a tax deduction for interest payment. So when it makes interest, so it can claim tax deduction. So profit will reduce. And the group found out that the treaty between B and C, interest withholding is only at 5%. Normally, it will be at 10% or 15%. So they found that the treaty has been negotiated to such an extent that the rate is fixed only at 5%. This is actually true. If you look at India-Mauritius tax treaty, interest withholding is only 7.5%. You take any other country, it will be either 10% or 15% withholding tax. Now, don't ask me who decides this 5%. It is decided by the bureaucrats. So when they negotiate, they decide the rates. It is not public. Public doesn't come to know about these rates. So what the group has decided is, this is what many tax professionals do this, study this, find out, okay, TK, tax arbitrage. In a treaty between B and C, interest is only 5%. So therefore, when country B makes this payment, interest payment to country C, tax withholding is only 5%. Because under the treaty between B and C, withholding tax rate is specified at 5%. That apart, B can also claim it as a expenditure, so deduction. So B is profit, B is a high tax jurisdiction. So B can claim it as a deductible expense. So its profit will also come down. So this is advantage. Now let's look at country C. Country C, we saw Cyprus, is a zero tax. So the interest is not taxable. Interest is not taxable. And then in country C, there is no withholding tax on dividends, because this is a low tax, nil tax. They will never have tax on anything. So when this interest, whatever interest it has received from B, it will go back to country A as dividends. At that point, C will not do any withholding tax. Now let's go to country A. Dividends are exempt from foreign subsidiary. So if you see, overall tax cost is only 5%. Overall tax cost is only 5%. So therefore, these kind of circuitous routes are used for tax planning mechanism. I repeat again, country A sets up a finance company in a low or a nil tax jurisdiction. and then that company, the financing company, in a low tax or nil tax, will instead give the loan to the group company, country B here. Very simple, So instead of giving directly, it will give, because one of the reasons could be the treaty between the parent and country A and country B, the withholding tax rate may be very high, and also it depends on how each country has it. So the treaty between country A and country C will be more favorable, just like how we saw. So what happens is this country A will set up this low tax finance company in Cyprus, gives equity there, and then that company will give loan to country B. This is to make use of the good tax treaty between B and C. Withholding tax is lower, and country B can also, instead of parent pumping it as equity, what they will do is, now since it is a loan, tax deduction is claimed by country B. So again, country B saves tax here. In country C, it is a low tax or nil tax jurisdiction, so nothing is taxable. Interest is not taxable there. And then there is no withholding tax on dividends. It just gives to country A, passes on. So this is just a holding company, shell company. It just passes on the interest as dividends to country A. In country A, dividends are exempt from foreign subsidiary. So this is a very good tax optimization, or whatever you want to call tax planning. So therefore, these are some of the strategies. I hope this transaction, we discussed this. We discussed this when we discussed thin capitalization. If you recollect, during transfer pricing, instead of giving equity, they will try to smartly give it as a debt. I just added this variation for you to know how tax treaties are used, how these multinationals do these kind of structuring. So in here, you take a plain parent subsidiary transaction. Instead of giving it as equity, they will give it as a debt, because the subsidiary can claim interest and they will pay less tax. That is why the thin capitalization was introduced. You see, in many Indian subsidiary, share capital will only be 1 lakh or partly 10 lakhs. But huge employees working, huge infrastructure, and rest of all will be funded as debt. Because debt means you will pay more interest. Interest means deductible. So they will try to plan in such a manner, instead of giving it as equity, give it as a debt, so that way taxes are paid less. So these are the kind of tax avoidance strategy that have been used, making use of all these treaties. Now, why I gave these examples are because I want you to appreciate the fact that what was the reason for introducing tax treaties were avoidance of double taxation, but eventually it paid more room for double non-taxation, or very, very little taxation than what was anticipated. So countries or multinational enterprise exploited the tax treaty network, and with globalization, with lot of tax havens. So these kind of structurings were possible. So in 2009, after the global financial crisis, Lehman Brothers crisis, countries were short of revenue. It was huge financial crisis. So countries didn't get revenue, and every country needs revenue to do their developmental goals, take care of their people. So what happened was, all the countries decided enough is enough. We cannot allow these kind of tax strategies, because tax is our major revenue. For a country, what is a major revenue? Collection of taxes. And these multinational enterprises, lot of survey found out that they were paying little amount of taxes. So hence, in these cases, so the countries decided that it is time to stop all these tax planning strategies, and hence the G20 at that point in time, the group of 20, the G20 countries, the top 20 economies, came together and said, how can we collect revenues? We are running short of revenues. What is that we can do? So they set up this base erosion profit activities for governments in terms of giving them ideas like a think tank. So they asked OECD, look, we are losing huge amount of money in tax avoidance and tax revenues, tax avoidance and evasion. And, multinationals are exploiting tax treaties and, coming out with innovative structures. So how do we go about in avoiding or get back the tax revenues? So that's how the BEPS framework was introduced by G20. And then in 2015, OECD came out with a report identifying the major areas as to where these tax avoidance and tax loopholes were happening. And they published a report. So in fact, what they did is they first did a diagnostic check. What is a diagnostic? Find out where and all you have problem. And then they came out with a analysis, or you can call it as a medicine, because diagnosis, and then you find out the medicine. And then they identified in their diagnosis that these are the major areas, the one before your screen. These are the areas where multinational enterprises are avoiding taxes. So they came out and then said, we can have these BEPS actions. Now, what they have done is they identified 15 actions. Not all are tax evasion. So basically they said, we have identified these 15 action items. If we work on these 15 action items, we can try to ensure that there is no more tax evasions or tax avoidance. Now, if you see hybrid mismatch arrangements, it comes under coherence. What is hybrid? We already seen this. Remember the example I gave here? These are actually hybrid mismatch arrangements. That is hybrid financial instrument, hybrid entities. So therefore, you just have to give me a minute. Yeah, sorry. So hybrid mismatch arrangements is one aspect where people are avoiding taxes, and then interest deduction. Interest deduction is nothing but your thin capitalization. And then they also found out that some countries were having So some interest deduction is nothing but your 94B. Harmful tax practices. That is, some countries were notorious, were giving a lot of tax freebies, incentives. So they identified what can be the benchmark to ensure countries don't come and give huge tax incentives or encourage tax avoidance. So basically, I will not go into all these aspects. It will become very theoretical, and it requires, so this is what actually you will be doing in the future. All I'm trying to do is plant a seed that, what evolved. So eventually we started with double taxation. Today, we are with double non-taxation. The 100-year journey has led us from double taxation avoidance to avoidance of double non-taxation, which means countries were avoiding taxes, were making use of all these loopholes. So the BEPS action plan, the base erosion profit shifting, is largely to ensure that it is an anti-avoidance mechanism. So we've been discussing only anti-avoidance. So these are all anti-avoidance mechanisms or strategies which will help governments to ensure that multinational enterprises do not get into aggressive tax plannings or enter into structuring arrangements which will facilitate the tax avoidance. So this is in nutshell the base erosion profit shifting action items. So all I wanted to tell you, through the case studies we did with us, how multinationals were exploiting these uh, mechanisms and avoiding taxes, and the BEPS was largely introduced to plug all these loopholes and avoidance. Now, one very interesting aspect is they also identified digital economy as one of the reasons for tax evasion, and this is currently a work in progress. This is currently a work in progress, but nevertheless, India has introduced equalization levy, which we have already discussed. That's why I called it as a unilateral measures. Now, OECD is working on coming out with a solution. So this is work in progress, and this is what we are going to focus. Multilateral. See, I will not go deep into all these aspects. It is there in the material, but please understand the essence. The essence is this. The idea is they want to ensure that, for example, avoidance of PE status. So they want to bring substance. So any transaction, there should be substance in it. It cannot be a mere form. Like what we saw, you come back to this example. If you recollect here, this low tax finance company has nothing. There's no substance there. It is clearly a shell entity started only for facilitating tax avoidance. So now going forward, you have to prove substance. You have to prove the reason for you setting up a company in Cyprus. So you just like that cannot go start a company in Cyprus, Barbados, Jamaica, St. Kitts, Cayman Islands. So these are the developments that has happened under the BEPS framework. Now, look here. So preventing tax. So they split it into three buckets. Coherence. What is coherence? When I should also have the same treatment. If I'm not taxing it, you should tax it. If I'm giving it as an expense, you should give it as an income. When I mean you, the other country. So they are trying to bridge coherence. Coherence is what? A equal treatment. If I'm not taxing it, then one of us should tax it. It cannot go double non-taxation. If I'm taxing it and you're also taxing it, let us give credit. That was the original purpose. It cannot be a situation where I give deduction and you also don't tax, then the purpose is waste. So the coherence bucket is to ensure that one country is not taxing, other country must also tax it. So that is coherence. Substance is very simple. We all know this, substance over form. Create substances. And transparency and certainty. Now, what is transparency is your documentation. They want you to maintain various documentation to ensure, to prove that all the transactions you are done are genuine commercial transactions. So just keep these three aspects in mind: coherence, substance, transparency. The idea is to ensure that there should not be any tax abuses. There cannot be any tax avoidances. So you should not abuse by not paying tax. That is the objective. Now, as I mentioned to you, I've already covered this hybrid. I've already shown you where can be interest deduction. CFC rules is not relevant for India, so don't worry. This is only relevant for developed economies. India do not have a CFC issue. It is largely for countries which have outbound investments, which are capital exporting nations. India is still a capital importing. We are highly dependent on foreign direct investments. So anyways, I'm not going to spend time on CFC rules because as an examiner, I will not waste my marks on CFC because it is not that widely relevant in India. Remember, these action items are for global. These are created not specifically for India, not specifically for Jamaica, not specifically for China. So these are basically diagnostic guidance reports. So countries can adopt from these reports whatever they want. So CFC rules is largely prevalent for developed economies. Developed economies were losing out tax on CFC aspect. So therefore CFC rules was introduced, anti-avoidance. Vodafone case is also a classic treaty. Vodafone is not necessarily a treaty abuse, but if you look at Vodafone, they would have multiple layers. So Vodafone is a classic case of substance over form. They had multiple companies, and many of those companies are just mere letterbox companies. So substance. So definitely Vodafone is a classic case of base erosion and profit shifting. So now going forward, you cannot just like that set up a company in Cyprus or set up a company in Cayman Islands. You have to prove substance as to why did you do that, what is the purpose for you to get the treaty. So all these things are tried to cover in BEPS. Now today we will be discussing post break, we'll be discussing on MLI. I'll tell you why we need MLI, because if you recollect, all these are multinational enterprises. So how much ever I bring 94B, I can also bring, if you, let's see what India has done. If you see, now if you look at India, India is a very active participant of BEPS, because India feels that many multinationals are avoiding tax in India. So India has always been very proactive. We have introduced equalization levy. We have introduced transparency in transfer pricing, country by country reporting. We also have place of effective management test. This is for hybrid dual residency, buyback. We amended the treaty with Mauritius, Cyprus, Singapore to remove capital gains exemption. We also have a GAR. So all these measures have been done under the Domestic Act. Very good. So this is a good mechanism, good start. You should, domestic at least is covered. But what happened if your treaty is not amended? With regards to Mauritius, Cyprus, Singapore, yes, you are able to amend it. In fact, Mauritius treaty, it took more than 8-9 years for us to renegotiate. Mauritius was not willing to come because Mauritius was benefiting from India. So therefore, unless you amend, unless you amend the tax treaties, there is no point in just making your domestic amendments, because these multinationals will try to take advantage of treaties and then take section 92 benefit, that is treaty or act, whichever is beneficial. Because many of these treaties are old treaties. Treaty entered in 80s, 90s, especially in 90s when India was very keen to get investments, we gave very favorable treaties. But now it's a different ball game. So therefore, we need to first amend the treaties. And that is what we are going to look a new concept, which we will see is called multilateral instruments. We are going to look at multilateral instruments. If you see a multilateral instrument, that is going to be the focus post break. Now, what is this multilateral instrument? Why do we need multinational instruments? How does it operate? Basically, multilateral instrument is to give effect to all these BEPS action. In one single shot, you sign, all countries will sign multilateral instrument. In one single shot, your existing treaties will get amended. Because amending a treaty is not a very easy task. Because both the countries' negotiator will have to come, discuss. It's a bargaining. They will not agree. It will go for a very long time. Negotiation, in many cases, negotiation will end impasse. And then after negotiation, let's assume they come to a consensus. There are some legal procedures. It will take at least 5 to 8 years to amend the treaty. And there may be government change. Officers will keep changing, transfer of officers. And many countries, there won't be any international tax officer. So he will have to do various aspects. In India, we have international tax board, but you cannot expect this in many smaller countries. Everybody will do everything, including GST, indirect taxes. So it is not at all a very easy task to amend the treaty. It will take a lot of time. So therefore, one of the BEPS idea was, let's sign a multilateral instrument. So that way, we will try to bring in all these anti-abuse mechanism we suggested automatically into treaty. So we can avoid bilateral treaty amendment negotiation, which will take another 30-40 years to amend. India has entered 100 odd treaties. You keep going to one after then let's amend the treaty, it will take ages. So multilateral instrument was introduced as a shortcut or a faster route to introduce these anti-abuse provisions in the existing tax treaties. So we will look deeper into multilateral instrument. Let's take a break and then let's reassemble at 8 o'clock and let's see how these multilateral instruments function. And these MLI are applicable from 1st April 2020 in India. That's why it is very important for assessment year 2021-22 for all those who are taking up this assessment year for assessment 2021. MLI is already in effective, so you may definitely expect a question on multilateral instrument. So we will discuss as to how MLIs work and how is this different from a bilateral treaty, or is it first of all different? All those mechanics we will discuss post break. So let's reassemble at 8 o'clock and I'll take over multilateral instrument. All right. Welcome back. See, so what I was trying to do in the pre-interval block was basically trying to explain how people make use of the international tax strategy, and it started off for avoidance of double tax, and eventually went on to facilitate double non-taxation. I'll maybe uh, for those who are not familiar with the tax treaty network, I'll give you an example how, see, under the India Mauritius treaty, there is a clause for capital gains. Now, before India Mauritius treaty was amended, it says a Mauritian resident selling shares of Indian company or anything, then capital gains will be taxable only in Mauritius. Shall be taxable only in Mauritius. So let's take a scenario. A US company wants to set up in India. So for the US company, India is a market, and after a few years, it wants to exit. Any company will want to create value and exit, especially in Western countries. It's very common, where you keep selling company, you may create a value. So what would what would happen is, ideally, a US company will set up a subsidiary in India, and then after some time, once Indian company has some value, it will sell the Indian company, that is, sell the shares of Indian company to whoever is ready to buy. So thereby, US company will make capital gains. Correct? Now, under the India-USA treaty, since the shares are Indian company shares and value is derived from India, India also has the right to tax the capital gains. So in India, the US company will pay capital gains tax, and in US also it will pay capital gains tax because it is a resident. Normally, like India, US also taxes global income. So now what happens is, in US, there is a capital gain tax from India, and US will also levy capital gain tax. So only way is take a credit. But there are some US domestic rules which doesn't give 100% credit of the India tax. So therefore, so let's say in US it is taxed at 30% capital gains, roughly. Okay, let's keep it as 20%. 20%, and India it is taxed at 20%. Now, under the US domestic laws, not the entire 20% allowable, only 10% is allowable. So which means effectively there is a tax cost of 30%, 20% in US and 10% in India. So 30% is the effective tax cost. Now, what US now smartly does is, US has a Mauritius company. This is a intermediary holding company. This is just a shell entity, box, your paper box company. And then Mauritius company in turn holds the India company. Now, when the US company decides to sell the shares of Indian company, sell shares of Indian company, what it will do is, instead of selling directly Indian company shares, it will sell the Mauritian company shares to another US company, third party. So when I sell this Mauritius, automatically my mother goes daughter will also go. So the new structure will be the new US company will be holding Mauritian company that will have the ultimate income. That is the US company 2. I hope you are clear now. I hope this structure is clear. This US company 1 wants to sell the shares. Okay, they're happy with India business. Now they want to sell the Indian company, divest it. So it finds a buyer, US company 2, who's ready to buy at a good value. So now what US company 1 will do is, instead of selling directly the Indian company shares, it will sell the Mauritius company shares to US company 2. So therefore, what is happening here is a transaction of a Mauritius company shares, and not Indian company shares are sold. So therefore, in Mauritius, there is no capital gain tax. There is no capital gains tax. So this is a classic treaty tax planning. So they avoid one leg of taxation. In India, no, India will not be an issue because I'm not selling any Indian company shares. This was what Vodafone was trying to do in Hutch. So what Hutch did was sold India. Hutch is an SR, sold it to Vodafone. So what they didn't directly sell Hutch is an SR, sir. They sold the shares of Hutch Cayman, which ultimately held Hutch India, to Vodafone Netherlands. So how these things are happening is through this treaty route. Now, to avoid all these treaty related tax, because international tax is all about treaties and other things. To avoid all these jugad, the countries came together and set up the BEPS initiative plan. So what happens? So what happened is these companies came together and found. So these countries came together, set up a action plan called. They kept a project name, base erosion profit shifting, and then they identify where are the areas. These tax evasions are happening, tax abuse. So identify 3 buckets: coherence, substance, transparency. Coherence is basically if one country is giving deduction, other country should tax it. So what are the measures to be taken? We saw some examples of how hybrid mismatch happens through different instruments. So what they will try to do is, if in India there is a deduction given, then the other country will not exempt it. They will tax it. Even though in their domestic laws, it is exempt. If you remember this example, where CCD is paid in country A, it is exempt. If you remember this example, in country A, it is exempt. But after the BEPS action plan, action 2, after the BEPS action 2, one of the recommendations they have given is, if this country B has given deduction, yes, country B is treating as debt and it has given deduction, then the other country, which is country A, should not exempt it, should tax it. They should not exempt it, they should tax it. So that way, deduction is claimed here and income is taxed. So these are the principles that is set out under the BEPS. If here deduction is given, here country A should not exempt it, even though under the domestic law it is exempt, but then this will be treated as a anti-abuse mechanism. So when you are trying to evade taxes, abuse, you can always override and say, I will not give you the exemption because you are trying to play smart by using this kind of instruments, CCDs, where I treat it as equity, you in the other country treat it as debt. To avoid all these jugad, they say if this country has deducted, then the other country should include it as income. That expenses has to be. So that way, accordingly, in one place, at least in one place, it gets taxed. And similarly, in these kind of situations, You cannot just like that have, you remember this example, you cannot have anymore Cyprus, these sham entities, brass plate entities, there has to be a substance. You should tell why are you setting up the country in Cyprus, and you should prove that there is a commercial decision beyond the tax for setting up in Cyprus in order to access the B and C tax treaties. So they're saying no more, you cannot just like that access a treaty. You should, the main purpose, principal purpose of the treaty you should prove that it is not for tax avoidance. You means the taxpayer must now prove that I have set it up in Cyprus not because it is a low tax jurisdiction. I find some substance is there. So therefore, through these anti-abuse mechanisms, they are trying to avoid these kind of tax planning. Now, how they are avoiding is through the BEPS mechanism. Now, if you remember before the break, I said, yes, good, you have brought these solutions, but they have to be incorporated in the tax treaty. Unless you incorporate them in the tax treaty, it will be very difficult because the existing tax treaties don't have such provisions where I can say that the main purpose is only to ensure not to avoid taxes. I cannot say that once you have given deduction, the other person should also give income. All these are new suggestions given in 2015. But many of the treaties don't have these solutions. So therefore, what the government, all the government did is, if we have to go renegotiate all the tax treaties, it is very time consuming. And India has entered around 100 odd treaties. So I cannot go everywhere. And because you have to factor a lot of things, time, because I have a tax officer has to go to another country, so travel, budget. As I mentioned to you, some countries don't have adequate resources, so a lot of administrative practical issues are there. So these governments said, if you are going to implement all these solutions in the existing bilateral new treaties, fine, well and good. New treaties I can always enter. In fact, India entered into a new treaty with Hong Kong. You can go and see this India-Hong Kong treaty. It's available here. You go here and download Hong Kong treaty. Hong Kong treaty was a new treaty. So this was introduced. India, was this came into force in 2019. To the effective to the so in the case of India, Hong Kong, it is very easy. It's very easy to negotiate, put all the BEPS related. India did it actually. A lot of BEPS suggestions were introduced. If you see the preamble itself, okay, the preamble is actually not amended. One of the conditions in BEPS is your preamble should also says for non-double taxation, to ensure that there is no double taxation, non-double taxation, not only for the avoidance of double taxation, but also to ensure that there is no double non-taxation. So the idea of treaty is not only for avoidance of double taxation, it cannot be a case for avoidance for double or encouraging not double non-taxation. There has to be at least some taxation happening. So the India-Hong Kong treaty, many other clauses introduce a lot of BEPS provisions. You can have a look at it. So therefore, what about for those treaties which India have already entered? To renegotiate is, for, as I mentioned to you, to renegotiate with Mauritius took almost 8 to 9 years just to bring Mauritius into the negotiation table, because Mauritius didn't accept to India's certain renegotiation clauses. So it becomes very bureaucratic, political as well. So therefore, what the OECD G20 through the BEPS action plan decided was, See, these are all anti-abuse provisions. We are only introducing these provisions to ensure that taxpayers don't engage in abusive measures, abusive practices, aggressive tax planning, don't get into artificial arrangements like creating sham entity. So therefore, let's come out with a new concept. So the new concept is multilateral instrument. So what is this multilateral instrument? So what they decided was, let's enter into a multilateral instrument. So under the multilateral instrument, we'll bring all these anti-abuse provisions under the BEPS action plan. So it will be like your agreement. It's an instrument like your treaty. It's a multilateral treaty. So we will bring all these clauses and we'll ask countries to be a signatory to it. And once they are signatories to it, then we will ask countries to whom should these MLI apply. So I will take you through the process. Give me a minute. Now, what is this multilateral? Your new study material will have these these things. Why do we need MLI? And what is MLI, when it is applicable, and how does it operate? So these things will be covered in your new study material. So don't worry. I think it is. I think it's already launched or published. So you'll get it soon in another week or so. So this is exclusively covered, the MLI portion. Now this MLI, as I mentioned to you, is basically to ensure all the anti-abuse provisions which have come out in the BEPS gets transposed into the existing tax treaties. Because if it is not transposed into the tax treaties, it will be a very futile exercise. By just amending your domestic law is not going to help. You should also amend your existing tax treaties. Now, how to amend the existing tax treaties? One way is these are all bilateral tax treaties. They are not, there is no multilateral. If you see your WTO, your trade is a multilateral agreement where all countries have agreed for tariff import. So that is a multilateral. All countries come together and sign one particular agreement. That is one agreement signed by 2 or more countries is called multilateral. But when it comes to your tax treaties, it is negotiated bilaterally. That is between, for example, I want to enter into a treaty with Neil. Me and Neil will negotiate and enter. I want to enter into a treaty with Preeti. Me and Preeti will enter into a agreement. I want to enter into agreement with Deepa. Me and Deepa will enter. But what I decided is my clauses are going to be very same. So then I ask Neil, Preeti, Deepa, Leela, Danush, Muthulakshmi, come together. Let's all, these are the standard terms and conditions. Shall we all agree, so that when we do a trade with each other, we will try to follow this. So if you all agree, then it becomes a multilateral instrument. So that way, the signatories to the multilateral will follow the agreement. But when it comes to a bilateral treaty between me and Neil, there is no need for Preeti to follow what is that between my treaty and Neil's, between a treaty entered between me and Neil. So India, Mauritius enters into a bilateral treaty, then somebody, a taxpayer in Hong Kong, need not worry about it. because he is not a party to it. Only a Mauritian taxpayer and Indian taxpayer will have to bid. Similarly, USA and Australia have entered into a treaty. India need not worry about it because it is a treaty between USA and Australia. So tax treaties are bilateral. The reason for tax treaties being bilateral, especially income tax treaties are bilateral, is because taxes, as I mentioned to you, are sovereign. So so now, you don't want a situation where somebody comes and tell you this is how you have to tax. You have to decide it. So countries will come together and say, hey, this income, okay, for a UK resident, this income will be taxed in UK only. India will say, no, this has to be taxed in India. Okay, let both of us tax. Let's give a credit. So taxes are basically allocating of taxing rights. Who will get the right to tax? Otherwise, it will lead to double taxation. So therefore, this is why these are called bilateral tax treaties. Now, in order to ensure that these tax treaties, existing treaties which have been abused by taxpayers, to plug the BEPS actions were introduced. Now, how to implement it? Otherwise, you have diagnosed these are the problems. You are given solution as to how to plug these loopholes, but then it has to be made into a legislative format. So that is why the OECD came out, the OECD BEPS action plan came out with a concept called multilateral instrument, because these are all only anti-avoidance mechanism. We will put everything in a multilateral agreement and we will ask all the countries, whoever is interested to sign, to come and sign it. Whoever feels that there is a tax abuse happening, they are not getting their fair share of taxes, let them come, and then we will try to see how we can annex it, transpose it into the tax treaty. So this is the reason why multilateral instrument, you call it multilateral convention, multilateral agreement, you can give any name to it. The point is, it is basically to ensure that your existing tax treaties also contain clauses pertaining to these anti-abuse mechanism. Look here. Contrary to the objective of tax treaties to prevent double taxation, over a while the tax treaties unfortunately facilitated for double non-taxation and also facilitated for treaty shopping, the Indo-US Mauritius, by taxpayers using tax treaty network to dodge taxes. So therefore, what happened was the BEPS agenda, 15 action plans were brought out by the OECD and the G20 mandate to tackle the unfair tax planning mechanisms adopted by MNEs. All these things are there in your new study material, so don't worry. The action plan, the MLI, is intent to put into play the anti-avoidance solutions proposed. The need for such an action item is because currently there are more than 3,000 bilateral tax treaties, and to invoke the solutions proposed under BEPS, these bilateral tax treaties have to be amended. Amending the treaties is easier said than done, as they are bilateral and involves cumbersome legal process, as each country have their own constitutional or other legal mechanism to invoke international treaties into their domestic laws. So each country has its own mechanism. China has a mechanism, different mechanism. India has a different mechanism to invoke. Similarly, a lot of countries have Brazil. In Brazil, it is very difficult to invoke international treaties. And in many countries, it has to pass both the houses of the parliament. There will be, and in Switzerland, people have to vote for treaty amendments. So each country have their own mechanism. So therefore, it is very difficult to keep amending. So that's why, in order to transpose them into the tax treaty, a multilateral agreement was undertaken. So MLI, or multilateral instrument or multilateral agreement, is entered by 3 or more nations. I have already given an example. The WTO is a classic case of multilateral agreement. So action 15, multilateral instrument, the BEPS MLI is exclusively to entered to ensure there are double non-taxation and reduction of taxes. That is, the former objective was to avoid double taxation and promotion of economic relations. The original idea for the tax treaty was to avoid double taxation and promotion of economic. Here, the MLI's objective is double non-taxation and non-reduction of taxes. Non-reduction of taxes. So this is why MLI has been was introduced. Now, MLA will not modify the treaty by directly amending it, but it will have to be read together. So when you read a tax treaty, I'll show you. So let's take India, Singapore as an example. India and Singapore have signed MLI. So I go to Singapore tax treaty. Now, if you see, this is a new concept called synthesized text. That is, the synthesized text, look here, multilateral convention to implement tax treaty related measures to prevent BEPS, and the agreement between India and Singapore. So this is a synthesized text, is basically to make your life easy to read both. So what happens is, this is a bilateral treaty. If you see, this was a bilateral treaty entered between India and Singapore. Now, after signing MLI, your MLI will get added to the tax treaty. So thereby it becomes multilateral convention to implement BEPS and your existing double taxation. So the MLI is only for anti-avoidance measures. So therefore it gets added into the existing tax treaties. So this is the reason why your action 15 came into picture. It is an effective tool to implement anti-avoidance measures in a synchronized manner without the need to bilaterally renegotiate each and every agreement. Synchronized manner. So therefore, all countries who agree to the BEPS solutions will come and sign the multilateral agreement. So we are going to see how the mechanics, but why MLI? The MLI is basically a tool to implement the BEPS solution into the existing tax treaties, because renegotiating tax treaties will take time. If it is a new treaty, tomorrow, let's say there is a new country that is coming up, or for example, India does not have a tax treaty with Bahrain. India and Bahrain enter into a tax treaty, they will factor these BEPS solutions while negotiating the tax treaty. So for a new tax treaty, not a problem. What about for the old tax treaties, existing tax treaties? Because if I don't amend them, then these taxpayers will still use the tax dodgers will still use these tax treaties for their benefit and still avoid taxes. So therefore, to plug these practices, a solution came about that let's sign an MLI, multilateral agreement. And the multilateral agreement is a tool to implement the anti-avoidance measures in a synchronized manner without the need to bilaterally renegotiate each and every agreement. So the BEPS MLI acts as a retaliatory tool for tax administrators to use against tax dodgers, tax evaders, as it can disentitle a notorious taxpayer from undertaking treaty shopping or availing unfair treaty benefits based on the anti-avoidance measure. So this will give a tool for tax administrators and say, hey, look at the agreement. You cannot use India Mauritius anymore, or India Cyprus, or say India Netherlands, because MLI says there should be a substance. You should have entered into a transaction not for tax purpose. That show me there is a commercial reason for entering into this transaction. Show me why did you set up a company in Netherlands? What was the reason for you? So therefore, the BEPS solutions gets transposed into the existing treaties. That is why the MLI is very, very important for implementing the BEPS action plan. So this is very important because India is a signatory. India has been very vocal about BEPS. So therefore, and already India has entered more than treaties with more than 90 odd countries. So India badly needed to implement BEPS because they felt many countries are using India's treaty network and avoiding taxes. So for all the existing treaties that India has entered with, they felt the MLA BEPS solution is required. So India is a signatory to the MLA network, MLA agreement. As on date, there are more than 90 countries which have signed the MLA agreement. So all these 90 countries are signatories to the MLI. Notable exclusions are, that is, some of the major country which has not signed the MLI are USA. USA has not signed this MLI because USA says, I have whatever anti-avoidance measures you have come out in your BEPS action, I already have in my existing tax treaties. So I don't need your MLI. This is USA's aspect. The fact of the matter is, it is to a certain extent true because the OECD action items, solutions for anti-avoidance, many of the solutions are inspired from US. So therefore, US says, you have taken from me, why do I need? So US is not there. Brazil is not a signatory. The reason for Brazil signatory is because there are some legal issues in signing international agreements. So that is why. But otherwise, top 90 odd countries have, more than 90 odd countries have signed the MLI. Now, how the MLI will operate is, all these 90 countries which have signed the MLI, then, so it does not mean that, say, let's take India, Singapore is also a signatory, Germany is also a signatory. So let's take Singapore and Germany as an example. Now, India, Singapore, Germany are also the signatories of MLI. So you may wonder, since Germany and Singapore have also signed the MLI, the existing treaty, I showed you the Singapore treaty. Let me also show you the Germany treaty, because since I took Germany as an example, I'll show you the Germany. This is Singapore. Now let's go to income tax website and go to Germany. Search. Now, if you see, you will get only the double tax agreement. You remember, when you go to Singapore, you get two. That is the double tax, as well as the synthesized tax is nothing but your MLI and DTL put together. So in Singapore, you get the MLI. But whereas when you go to Germany, you can find out only the double tax treaty is there. That is agreement for avoidance of double taxation with Germany. There's no mention about MLI. So therefore, the reason is for these 90 countries, there is a flexibility that is given. That is, not automatically the MLI provisions will apply. The countries can notify for whom it should apply. So Germany, when they notified, did not include India. Germany did not, so this is called covered tax agreement. Germany did not notify India. So therefore, even though India is a signatory to the MLI, Germany is a signatory to the MLI, but when it comes to India-Germany tax treaty, Germany has not notified India as a covered tax as a covered tax country. So therefore, MLI provisions won't apply for India-Germany tax treaty. Now, why Germany has not notified? It is a decision taken by Germany. Has India not notified any country? No. India has notified all the countries with which it has entered into treaty except China. Now, why India has not notified China? India has entered 90 countries, but India has notified all the countries except China. Nothing to do with India-China war or politics here, because India, China, just before signing the MLI, India-China renegotiated their tax treaties. So they bilaterally sat together. See, the idea of MLI is to ensure that you don't have time for renegotiation. If basically it's a cumbersome process, then the MLI will help you. But if you have already, they have come together, China has come together and renegotiated, then there is no need for MLI. So you can invoke this anti-abuse provision, the BEPS anti-abuse provision in the renegotiated tax treaty directly. So this is the slight variation, that is, I won't say variation, the nitty-gritties of MLI functioning. So one, the MLI is majorly to ensure existing tax treaties get amended automatically without need for countries renegotiating bilaterally. Having said that, there is some flexibility that is given, because multilateral agreements are a standard template. This is the action. So these are not bilaterally negotiated. They are a standard set of clauses that is there, that all the countries have signed. These are not negotiated. So you will have ready-made, it's a template, and you agree to those template. But in order to ensure there is some flexibility to be given, it cannot be so rigid. What the MLI framework did is, countries can choose to whom it will apply and whom it will not apply, especially within the signatories. So Singapore notified India. India also notified Singapore. India notified Germany as a covered tax agreement, but Germany did not notify India. Similarly, India did not notify China. So MLI won't apply for India-China treaty. So this is I'll give you an example. Whether India and Australia DTL is a covered tax agreement under the MLI. Covered tax agreement means both countries should notify. Only then it becomes a covered tax agreement. In that case, the MLI will come. So let's see how to step by step apply. Whether India and Australia already have a DTL. Yes, India and Australia have a DTL. Let's go see. I go to Income Tax India website, go to double international taxation. I am seeing whether India or Australia has a double tax treaty. Yes, India Australia has a double tax treaty. 2, whether India and Australia are signatories to the MLI. Now, where will you get these signatories to the MLI? You have to go to OECD website. Now you go to OECD website. This is actually the multilateral convention which is available in the web. So all the parties to it, these basically contain all the avoidance mechanism. Let's find out OECD MLI signatories. So in the OECD website, you will find out who are, don't worry, in your exam, they will not, obviously it's a written exam. So I'm only telling you how it works. So Australia is also a signatory to the MLI. Look at India. India name is also there. So as on date, we have 94 countries who have signed to the MLI. Now coming back to India and Australia both are signatories. Yes, both the parties are signatories to the MLI. Now we need to see. So you will ideally think, okay, India and Australia are signatories, so they automatically in their existing tax treaties, the anti-abuse provisions will get transposed. No, you have to go to another step. Whether India has notified. So this is the flexibility that is given under the MLI. Whether India has notified Australia as a covered tax agreement in its MLI. Under the deposit note, it's a formality. India notified Australia. Did Australia notify India? Australia also notified India. So therefore, India-Australia DTL is a covered tax agreement. MLI provisions will apply. So if you go to the website, you can see here, synthesize the text. Multilateral convention to implement BEPS and agreement between India and Australia. So therefore, India, Australia. I'll give you one more example. Whether India and Mauritius is a covered tax under the MLI. So now, both India and Mauritius, do they have a treaty? Yes, they do have a treaty. Whether India and Mauritius are signatories to the MLI, actually you go to that list, you will find out both are signatories. Now, whether India has notified Mauritius as a covered tax agreement, that is whether India wishes to apply the MLI provisions. Yes, India has notified Mauritius as a CTA. Whether Mauritius has notified India, no. Mauritius did not notify India as a covered tax agreement. So therefore, India provision matching provisions are not satisfied. Hence, MLI provisions will not apply. Only the existing DTW will apply. Let's go and verify this. If you see, only comprehensive agreement is there. There is no MLI. So therefore, yes, if only one of them notified, MLA is not applicable. Both the countries have to notify. Now, don't worry, at your exam level, they will ask, India and Mauritius are signatories to the MLI. Mauritius did not notify India as a covered tax agreement under the MLI. Therefore, whether the BEPS MLI provisions will it apply for India Mauritius DTWA, you have to give these steps and say, since Mauritius has not notified India, MLI provisions will not apply. MLI provisions will apply only if both the parties are signatories and both the parties should notify each other's treaty. It's a flexibility given. Now, why? Why is this flexibility given? These are anti-avoidance provisions. Why not notify? Is because, as I mentioned to you, for various reasons, take Switzerland. Sorry. Switzerland did not notify India. The reason for Switzerland not notifying India is nothing to do with that they are not in favor of anti-avoidance or anti-abuse. They also want abuse, but then they are domestic. They have to go and get their parliament approval. They have to go for a referendum, get their people's approval. And Swiss, some laws have said, you cannot, some countries says, when you enter into a bilateral treaty, you have to negotiate. You cannot just like that have a standard template. You have to remodify. So each country have their own unique mechanisms. So hence Switzerland did not notify India, but then Switzerland is parallelly renegotiating bilaterally with India. They told India, we cannot notify you. There is some legal, impediments, but let's sit together and renegotiate it. So there's a parallel renegotiation happening between India and Switzerland. So this is how the cover tax agreement will work. Similarly, the rest of the part, I will not go very deep into it. All I wanted to tell you is there are one more other important feature, or maybe both are interrelated: compatibility clause and reservation clause. What does that mean is, so compatibility clause is, it gives an option as to the MLI provision whether it should completely replace. Okay, all right. So Neil says information is overload. So that's what. So compatibility and reservation, I will not go deep into it. You can just read it. But I think at your level, they may not go into compatibility and reservation. They will only try to verify as to whether MLI is applicable. So what I will do is, you will in any case get this study material where there are some illustrations given. You can go through it. Meanwhile, what we will do, we just quickly look at what are the questions that is normally asked. Just trying to look at the study material. Yeah. So for base erosion profit shifting, these are the questions that have been asked. What do you understand by base erosion profit shifting? Describe briefly its adverse effects. So you all know it is very, very generic. I mean, when I mean generic, you know why do we need BEPS? Basically, tax avoidance and abuse. What are the adverse effects? Governments are losing revenue. Developing countries are not able to use tax revenues. And then new innovative business models have come and laws have not been up to date. So this is why the BEPS are introduced to avoid tax abuses. What are the significant OECD recommendations under Action Plan 1? Action Plan 1 is a digital economy. We've already discussed. That is your equalization levy. Action Plan 4 is a thin capitalization provision, section 94B. That is, you cannot give, your interest should not be more than 30% of your EBITDA. So many of the domestic provisions are inspired from the BEPS action. So so this is the kind of questions you can expect. But however, I believe there is a very high possibility that they may ask you, what is Action Plan 15 multilateral instrument? So you can respond that the idea of multilateral instrument is to ensure that the anti-avoidance solutions proposed by the BEPS action plan to be implemented in the existing tax treaties. Since it is very difficult to renegotiate the treaties, it is therefore decided to enter into an MLI, so that once you have a multilateral instrument, it will get transposed into the tax treaties. And they may go one step and ask, about the covered tax agreement. So as I gave an example between Mauritius, Germany, Singapore. So both the countries who are signatories to the MLI should notify. Now, if you remember at the beginning, why I said this is very practically, it has changed the framework for all. Once you guys finish your exam and then get into the professional life or the practical life, especially from a taxation perspective, if you're a tax practitioner, advisor, or even as a in-house tax function or CFO function, now you cannot just stop with tax treaties. You have to go one step further and then look whether multilateral instrument will also apply. So practically it has become very relevant, because when we enter into when we try to make a payment to a non-resident company, we now not only look at the bilateral treaty, we should also look at the multilateral treaty and see whether the transaction has genuine substance and they are not only paid for to avoid taxation. So therefore, the lot of responsibility is also on tax professionals to interpret correctly. So that is why this MLI is a game changer, is an evolutionary. So from bilateral, we were evolved into multilateral. And once we have a solution in the digital economy, people are saying that we may have another multilateral instrument, MLI 2.0, where all countries will sign an MLI for how to tax these digital companies. So anyways, all I want to plan in your mind is the evolution of multilateral instrument under income tax. So what I would suggest is you can always please look at I will stop here today, so you can have a look at the study material, and then if you have any doubts, I'm open to clarify them. So you can reach out to me. This is my email ID. So you please send me an email and then we can fix up a time and I'll be happy to call, or if you have any clarification, please send me an email to this ID and I'll be happy to clarify your queries. Now today's class, if you have felt, you see today's class is a very, very interesting topic as it, because this is a completely new topic for international taxation itself. And more importantly, this is a topic which has larger significance practically. So for those who have already done on international taxation, I think maybe in a portion to appreciate. But anyways, for those who have not had much of exposure practically on international tax, don't worry. The idea of today's is to basically introduce MLI, the BEPS action plan. So I gave you some structures as to how normally tax evasion happens. And then the reason for me giving those structures was multinational enterprises uses various countries' tax laws, tax rules, tax rates, and then try to take tax arbitrage. That's the bottom line. And then they try to plan accordingly. So now to plug all these things, the BEPS action plan were BEPS action plans were introduced. And in order to implement these anti-avoidance mechanism, the MLI was signed. So now going forward, any international transaction must have substance. It cannot be just a near, just give invoice, transfer, set up a company in British Virgin Islands. Everything has to have a proper substance. If there are some things which I want you to take away, whether or not it comes into your exams, all I want you to take away as a good professional advisor when you become once you start your career as a chartered accountant, since you're all aspiring, I want you all to advise, in a very proper manner, in terms keeping in mind that there has to be proper substance. There cannot be, see, the problem, what I have seen in our profession is we've always been told to save taxes, save taxes, save taxes. I do understand tax is a cost, but we need to balance it. We cannot go come out with these artificial structures, creativity to avoid taxes, because there is an element of ethics involved here as well. I'm not trying to be very preachy here. All I'm trying to say is just change your framework from, as a chartered accountant, many times we've been told how, save taxes, plan taxes. Yes, plan it, but plan it legitimately within the framework. And you need to, going forward, keep in mind that there has to be substance, and all these information will now be available with the tax authorities and across. So that's transparency, and there should be a legitimacy involved. So these are the aspects you need to keep into your mind, and please keep action 15 in your mind. So if you have any questions, so go through the material once you get into it, the new material. And I'll be more than happy. So maximum you can expect 3 to 5 marks, not more than that. And if at all they ask a question, they may ask on action 15. Otherwise, I would, if given a choice to me, I would be more than happy to use these marks on transfer pricing or equalization levy or on double tax avoidance agreements, than ask a generic question on how to avoid BEPS and all the theoretical question. But anyways, you never know. But watch out for 3 to 5. That's the maximum they can expect. But anyways, today's concept is more relevant practically as well, especially when you start your career as a professional, proper professional. So keep this in mind. If you have any questions, please feel free to email me. So all these materials and problems we solved over the last 5 sessions will be uploaded. And if you have any questions on transfer pricing, equalization levy, or even on application of MLI, you can reach out to me at any point in time. I'll be more than happy to assist. So I stop here, and I thank you all for your attention and being being with me for the 5 sessions. I hope there was some value addition. And if there are some concepts which you felt appears unclear, please let me know. I'll be more than happy to help you out. These are, for many of you, this may be new concepts because you would not have done international taxation practically. But as I mentioned to you, very easy from an exam perspective, 6 to 10 marks, or at least 6 to 15 marks, low hanging fruit. Please grab them. Don't miss out these low hanging fruit. So with this, I will stop today's session. Thank you very much. Please revisit these concepts the next few days so that it stays with you, and don't wait till your exam in May or November, whenever your attempt is. Just keep it in your to-do list for tomorrow or by this week, so that way you will have a firm grip on these concepts, and it will remain with you forever. All right. So thank you very much. Good night.